Thanks for joining us on this chat, Wizards of Finance. This is a conversation that we are bringing you along with Mirae Asset and, of course, CNBC TV18.com. I'm Surabhi Upadhyay. Now, over the last couple of weeks, as part of this series, we've been speaking about how mutual funds can be your road to long-term wealth creation and how you can use passive funds specifically to improve the overall profile of your mutual fund portfolio. Today, we'll talk about a very interesting subject, and that is global investing in equity markets beyond India. And yes, passive funds have a role to play in this aspect as well. We will specifically talk about how now you can actually reach out to markets beyond the US when it comes to investing in global equities. So let's take the conversation forward. My guests are Neeti Sethi, who is a chartered accountant and also a certified financial planner. And we also have with us Siddharth Srivastava, head of ETF products at Mirae Asset Global Investments. Thank you very much for joining in. Okay, Neeti, so let me open out with you. Tell us first thoughts, this whole topic about diversifying and looking at global markets. Why should we look around the world when it comes to our investments?
India is about 7% of the global GDP, and we are roughly about 2.5-3% of the global market cap. So there's a lot of economic activity and investment opportunity which is happening outside of our borders. What we also see happening in the last few years in India is that the number of options available to Indian investors to invest in international markets has gone up significantly, and the ease of investing also has improved. I do think the future is technology, and the best of tech innovation is happening outside of India. So it does make a case for investing globally. So it makes a definite case for us to be able to have some of these global MNCs in our portfolio. And that is what global investing does. So the way I look at it, just like you would diversify across asset classes and market caps and themes, country-wide diversification definitely makes sense, both from the point of view of reducing the risk as well as improving the returns from the overall portfolio.
All right, let's bring Siddharth into the conversation as well. Siddharth, so you tell us. I mean, a lot of people understand the need to go beyond India when it comes to their equity investments. But where does one begin? What would be the first steps?
When we are analyzing domestic funds, we still see some sort of overlap between multiple funds, right? But in global funds, things are a bit different. One fund can be very different from another fund. It can capture just one country, or it can be based on multiple geographies, or it can be just based on one theme like technology or healthcare. It can be thematic in nature. It can be capturing emerging or disruptive technologies by let's say being an EV fund or an artificial intelligence companies based fund, etc. So each fund based on its investment objective will carry a very different return and risk profile. So the first of all, investor should uh, judge, analyze what his investment objective is. Does he want to take exposure in a sector agnostic portfolio like S&P 500 top 50, which has created wealth, but let's say lesser than a FANG Plus or a Nasdaq 100, but it comes with a lower level of risk because it is sector agnostic in nature? Or investor is okay enough from a risk point of view to invest in a tech centric product, or after he has invested in US uh, broad-based indices, he is okay enough to invest in more thematic products, which, while it has created wealth historically, carries higher volatility.
Absolutely, yeah. That's an important point, really. Nidhi, I want you to come in on this. So, would it mean that global investing is for investors who are a little more advanced, who already know some of the market nuances, things like timing or which sector is hot or what the trends are? Or can even beginners look to take some exposure?
So I would think, Sulbi, international investing is for everyone, because if I have to look at a diversified, bucket of equity assets, there is no way I can exclude 97% of the market cap. So while all of us do have home country bias, I think even for investors who are, introducing themselves to the world of equity markets, there is a case for having at least a small allocation to global equity. So personally, what we do like is, broad-based global funds or even index funds, because they make a good fit for long-term portfolios. They don't require much churn, and they can actually form a part of the core asset allocation in the investor's portfolio. Coming to some of the other themes or sectors or country specific investments, I think they make a good fit for the more aggressive investors who are already been exposed to equity for a while, also know how international investing works, and are willing to take that higher risk in order to get a higher return. So while I think international equity should form a part of all equity investors' portfolio, the amount of allocation that goes into it and what kind of investment you choose would be specific to what's been the history of that investor with equity.
Okay, fair enough. So yeah, I guess more advanced investors can look at some of the more niche products.
Yeah.
So that now I'm going to actually get to the active passive debate, which you hinted towards just now. Now, for someone who's looking to start their journey in the global markets, I think the first question will be: should I just let a fund manager manage this because I don't know too much about a foreign market, and therefore should I go via the feeder fund route? Some of the funds in India, which then go on and invest in turn in global funds, or should I actually back an index via an ETF or an index fund? So, how do you answer that debate?
Yeah, so first of all, there are like multiple reasons and multiple sorts of factors which an investor should consider before choosing the right fund, especially in large cap category. That has been happening in US since a very long time. If you look at last 5, 10 years, PIVA report, etc., you'll find that benchmark tracking index funds or ETF continue to do well, and active funds are struggling to outperform. So especially in developed market, it makes more sense to invest in passive funds like ETF or index funds, or a fund of fund which is based on ETF or index funds, because not only you are removing the fund manager risk of underperformance, but you are also taking that exposure at a very low cost, because typically passive funds, the TER is low compared to the active funds. Also, one thing which people typically appreciate, especially when they're investing globally, is transparency, or a method-driven approach, and which is obviously something which index fund and ETF does, right? Because if I'm investing in, let's say, a country like Taiwan or a Hong Kong, or in US, I typically want to know what my underlying exposure is going to be like. I typically want more stability or more information regarding the kind of exposure I'll get, regarding the kind of companies the portfolio will have, and which typically gets associated with an index tracking fund like an index fund or an ETF. So these are 2, 3 reasons, and I think based on that, probably for a first-time investor, I think index funds or an ETF is the go-to product, because you typically have lower risk, it's low cost, and it's more transparent, and will probably provide more comfort to the investor when he's investing in any global market.
Okay, okay, that makes sense. That yes, you can follow a widely tracked index. You know exactly the sort of stocks that you're getting in, and the cost is low. So that's a good argument. But so that just to sort of delve a little deeper, then if you're looking to place specific themes within some of these global markets, let's say technology. Neeti mentioned that she's quite upbeat on technology.
So while in India, themes are still new in terms of coming out for or being available for Indian investors, and globally, thematic investments have gained a lot of traction. And if I have to consider thematic investment through passive, actually makes more sense, because, for example, will you be able to find a fund manager or an investment team who can, let's say, analyze a blockchain market or an EV market or a semiconductor market, etc., and create a fund around it, right? Passive simply provides a rule based approach to tap into these emerging and disruptive technologies at a low cost. So I think that is why, if you especially look in thematic space globally in US, you are finding decent amount of traction with people investing in lithium, battery tech based ETFs, in semiconductors, in EVs, in e-commerce, etc. I think eventually we are also going to get a lot of those options in India also, because as Niti said that in India, we are still, the market is still dominated by a lot of legacy sectors like BFSI. We are talking about IT consultancy, etc. We are now seeing spades of few unicorns getting listed, but in US you have, or in globally you have very rich ecosystem already of
Yeah.
companies into e-commerce, fintech,
Yeah.
EVs, autonomous, etc., which people want to take exposure in, right? They read about it, they read about how semiconductor is doing well, and they want to invest in those opportunities. And that is what passive fund can provide by simply tracking the index, which is based on that concerned theme.
No, absolutely, I take that point, but let me toss it to Niti as well. So, Niti, that's the question. I think any informed investor will understand that you need to play the big themes of today and tomorrow. So, whether it's clean energy, electric mobility, these will be the disruptive themes. The question is, should you play it through an existing, already known index, or would you feel safer if a human being, a fund manager, actually picks out stocks on these themes for you? Which approach would you take?
Sure. I think, before I get to that question, we are at a point where we have a large number of equity investors who don't even look at global investment. So I think, the first war to conquer is to see that there are people who have global investments as a part of their overall portfolio. And there it definitely makes sense to have passive index because it's low cost. There's no human involved, so as the index behaves, and it's easier to reason out with the investor as to why you should be looking at something like this. In terms of the exotic stuff, I think we will see that as a part of the portfolios. Definitely for the more aggressive investors and not, people who are starting out or have not done enough in terms of what they could do in equity otherwise. So I think this stuff would form a part of the portfolios. It will take some time because we still have to kind of align portfolios to including global investments as a part of it. And once we kind of achieve that, then we can look at, okay, what else is happening now in the global space which we would like to be exposed to.
Okay, that's an interesting point. You want to continue, Siddharth, and tell us a little more about it? Because till now, I think the only market most Indian investors are even considering is the US. So tell us about perhaps some of the Asian regions which could offer some amount of interesting opportunity.
Yeah, I think first market by default has to be US, right? Because people are more familiar, we know about, possibly are more aware about return and risk profile, and companies are probably well known if you look at the names. But if you look at, let's say, in east of India, you have Hong Kong, you have Japan, you have Korea, you have Taiwan, where a lot of interesting things are happening in, let's say, robotics, in semiconductor space, in 5G, Internet of Things, etc. If you look at tech giants which are listed on Hong Kong Stock Exchange, which are leaders in their own space. In fact, probably China is doing really well in EV space, in autonomous space. Robotics is something which is also being done well in the East Asian economies. So people can also look here for wealth creation. But having said that, again, it is important to know that each global market performs differently in different time period. So while we can see that Taiwanese market or Hong Kong market had created wealth historically, they have had its own set of risk factors. So people need to understand that. Adding these market obviously adds a new wealth creation avenue for the investor. It also helps in diversification because diversification reduces the risk of your overall portfolio. It provides the opportunity to invest in companies which are not available in US. It also provide opportunity to invest in companies which are catering to domestic users. Like for example, China has more than 1 billion internet users. So companies which are listed on Hong Kong are catering to such vast domestic opportunity set, which let's say US companies aren't. But it's important to understand what the portfolio is, what these companies are addressing, and understand the risk profile, and then invest in these markets also.
Absolutely. When you're seeking, big return, be sure to analyze the risk profile. That, of course, goes without saying. Which brings me to you, Niti. I mean, what do you think of some of these newer geographies, absolutely new horizons when it comes to investing? There is a passive route, but what should be the do's and don'ts here?
So I think the first thing to look at would be what kind of allocation do you want to have to global investments in your overall portfolio. Personally, for us, I would peg the range between 10 to 40%. So let's say an average of 20-25% of the allocation can go to global equity. Now, within this, again, we like to play on the side of safety. So I would like to have a higher allocation probably to the developed markets as compared to some of the new age exotic spaces. Having said that, for the investors who do fit into the high risk profile, I think there is a case for looking beyond US. I think there's traction happening in the emerging markets. Even in the developed space, Europe, Japan are some options to look at. And then, of course, there's things like tech. So just like you would look at the US tech, there's also China tech, which is interesting. Yet we would err on the side of caution and probably start slow on some of these spaces. And as we understand them better, we kind of increase the allocation to them.
Okay. I just have to ask you this, Siddharth. The moment you speak China, there is some trepidation that comes in because regulation changes so quickly. When it comes to investments from China into India, now we're of course talking about investments from India into China. Right now, is there any regulatory barrier at all in terms of my money, Indian rupees, that I want to convert in, the home currency over there and then invest in those entities? I mean, Chinese companies listed either on the mainland or in Hong Kong.
So, first of all, there are already active funds and passive funds which are taking exposure in Chinese market, and through Hong Kong also. So there is typically, for example, if you want to take exposure in China, Hong Kong is one very uh, r- good way to take exposure there. And from an investment point of view, when the fund is there which is investing in, let's say, Chinese companies which are listed in Hong Kong, of money from these companies. On the regulatory headwinds, while you mention it, there have been some which these companies themselves are facing, right? Last
Yeah.
9 to 12 months uh, uh, have been very from a regulation point of view very interesting, because these companies are facing a lot of regulatory headwinds relating to data security, policies and practices related to consumers and vendors, and also around anti-competitive practices. So we are seeing, obviously, for example, Hong Kong markets have corrected by almost 40% because of these issues, while these headwinds seems to have in a way abated now, but probably they may sustain for some time. The reason why I'm mentioning this is that once you are talking about investing or thinking about investing in any other markets like Hong Kong, which is one of the largest market globally, you are still faced with risk factors which is probably not there in the domestic market, which is there in these foreign markets, and hence you need to be aware about those risk factors before you seek these funds to create more wealth.
Okay, fair enough. Yeah, you must be aware of these risk factors. Also, study the offshore markets, of course, and the regulatory environment that prevails, the valuations that prevail there before you take the plunge. Okay, let's come down to the specifics and the brass tacks as well. And this, by this, I mean, the forex component of it, any other sort of taxation elements that we need to keep in mind. Niti, so when we invest in the US, there's great comfort that ultimately You will be holding those assets in dollars, and typically, the rupee depreciates against the dollar, and you are more or less, I mean, in most cases, you're better off after a couple of years. But if you're looking at other markets, non-US markets, and from a forex standpoint, what should one sort of think about, or what should one ask before making that investment?
So definitely, and that is also the reason that we are biased towards US, because we understand the currency movement and we have a history of the currency movement, and we know which way possibly it could go, because in global investing, currency volatility in fact is one of the biggest risks. It could improve my return on the positive side, and it could reduce my returns from that market on the negative side. In terms of investing outside of the US, yes, we do look at a little bit on how that currency has behaved vis-a-vis the INR, and that is also the reason that we keep the allocation a slightly allocation slightly lower than we would like to, until we've had enough history with the fund and investing in that market. So international investing, I think, is fairly recent in India in terms of the range of options that we have available today. So some of the funds which got listed in this space, we won't have access to those kind of themes or markets, until a few years back. So definitely we want to experiment. We don't want to shy away from these funds. Having said that, we want to know what are the risks involved, whether with respect to currency or that particular market, and only then decide how much of the money goes in. So we do a little bit of research around what we can expect with respect to the currency movement in that particular market.
Yeah, fair point. And Nidhi, with respect to taxation, how are most global funds treated, and is it completely geography agnostic? US, China,
Yes,
Taiwan,
so
wherever?
that's correct. That's correct. So global funds basically fall into the, you could put them in the category of debt funds as far as taxation is concerned, because, the 1 year long-term capital gains is only for in India equity, right? So 65% of your portfolio in India qualifies you as an equity fund in India. If you are not an equity fund, you are a debt fund, right? So even global funds, or even passive funds for that matter, who have 100% allocation outside of India, are classified as debt, which would mean that if you book your profits within 3 years, it is short-term capital gains, it's taxed at slab rate. And if it's more than 3 years, then of course you get the indexation benefit and 20%. So that's a little bit of disadvantage, I would think, with respect to Indian equities. Having said that, it still does make sense to have some allocation there.
Just to follow up on taxation, Nidhi, so that's with
Yeah.
respect to Indian taxation. But let's say
Yes.
when you are redeeming units, and ultimately it's the US stock or the Chinese stock that's getting sold because you want to redeem your units. What about home country taxation over there with respect to the capital gains regime?
So that's taken care of by the fund. If I'm an Indian resident who's investing in India, I would be taxed as per the laws here. So it would look at what was my purchase cost in INR and what was my selling price in INR, and my profits would be determined like that, and I would be taxed accordingly.
Okay, fair enough. Siddharth, from your experience and sort of understanding of this from a taxation point of view, or even from a forex point of view, what are the things that one needs to keep in mind?
No, I think Niti has touched base on these 2 points very well. If you're investing in foreign currencies, depends whether the currency in which you're investing is strong or not. Typically, if you're investing in US dollars based asset, typically US dollar appreciates against the INR in the long run, and that adds to the return which investor is generating in the short term. It can go down also, and there the investor return will reduce by the depreciation in US dollar. So it depends in which country the investment is happening, how strong that currency is, or behavior of a US dollar will be different from an emerging market currency. Typically, a developed market currency tends to appreciate in the long run. On the taxation front, again, agree with Niti that ultimately for the Indian investors, it is the same. It is taxed as debt-oriented scheme. But if someone wants to know what happens at for the home country tax point of view, the fund take care of it. For example, if a fund is investing in US, capital gains does not apply, but dividend related taxation apply. If I'm investing in another market, it is the tax laws which is pertinent to that market, but that is taken care by the fund itself, and investor typically does not need to worry about that. And then he or she needs to be concerned obviously with the taxes which is
But
going to be charged.
but wouldn't that in a way reflect in my NAV or my units? At the end of the day, home country taxation needs to be paid. I mean, I'm not sure about, let's say, Chinese taxation for instance.
Yeah.
But if there is a capital gains regime in that home country, that adjustment, will that not ultimately reflect in my returns? So that.
That will definitely affect the NAV of the scheme, because if the tax get applied to the fund, that gets adjusted, the scheme ends up paying it, and that ultimately reflects in the NAV of the scheme.
Okay, so from that standpoint, purely from a taxation sort of a comparison point of view, how does the Chinese markets sort of shape up or score?
So for example, it depends on in the country where we are investing in. For example, I think Hong Kong market also does not have capital gains which is applied on the mutual fund. So, but again, if the fund is investing in, let's say, a Taiwanese market or a Japanese market, then you have to uh, check. The fund has to check the applicable tax in those particular countries.
Absolutely. Got that. Got that. Okay, so let's sort of wrap it up with some final thoughts and final words of advice. Nidhi, so everything put together, what would you say? Global investing via passive funds, what are the most important things to keep in mind?
Surbhi, so I wish we could be country agnostic when it comes to equity investing, but obviously it doesn't work like that. We still have large part of our equity portfolios in India. However, it makes definite case for having global investments as a part of your portfolio. One, from the point of view of diversification, it definitely reduces risk, and also from the point of view of probably generating slightly better returns. But for me, even if the latter doesn't happen, but I'm able to overall reduce the risk of of the equity portfolio. uh, I think one should go for it.
Okay, got that. And Siddharth, your final words of advice on this subject?
He's saying, and to add on to that, uh, basically Indian equity markets are a very small share of global markets. Accessing global markets gives you different wealth creation opportunities, though it comes with its own set of risk. You can invest in companies which are part of your daily life. You can invest in companies which are part of emerging themes or disruptive themes. You can invest in known markets like US first, and then graduate towards investing in other markets. But it is important to understand what your investment objective is, what your risk profile is, and then choose the right fund. You can start with a 5% allocation, build on to 15-20% of your overall portfolio in global schemes if your risk profile permits. Some products can form part of your core portfolio. More risky products or thematic products can form part of your satellite portfolio. So it's all about how you build your portfolio with not only Indian funds, but global funds also, to create a better risk to return profile for your overall portfolio.
Okay, all right, Niti and Siddharth, thank you very much for joining in and explaining the nuances of for this very interesting subject, diversifying beyond Indian shores and looking at global markets in our long-term journey of wealth creation. Thank you for joining us on the chat.
Thanks, Sylvie. Thanks for having me.
Mutual fund investments are subject to market risks. Read all the scheme related documents carefully.